Good afternoon. This is Rob Barnett, and I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in commodity markets. Now, if you're paying attention to what's going on, you'll see that we've seen a tremendous impact from Russia's invasion of Ukraine in commodities. We're seeing some big reverberations. Coal is up over 60% today alone. European natural gas is up over 35% today. Brent is over $110 a barrel. One of the few commodities that's actually retreated is European carbon credits. But with that in mind, I think we should start with the gas complex. There's a lot of concern about Russian natural gas imports in Europe. I think it's one of the key variables that's helping drive that equation. So first, we're going to bring on Patricio Alvarez to talk about our gas outlook. So first, over to you, Pat. What's going on with the gas market, and where might we be headed as you look over the next couple of weeks and months?
Right. Thanks, Rob. So I think it's important to divide the scenario into the very near term and what the current conflict may actually do in the mid to long term for European gas. So the risks remain heavily skewed to the upside near term for European gas prices, and that's because of what you just mentioned. Russia's invasion of Ukraine is placing this looming threat of retaliatory pipe gas flow cuts into Europe, and also raises the prospect of potential disruption to Ukrainian gas infrastructure. And this seems to be the driver for the immense volatility you just mentioned. We've seen prices go up over 30% today, and even hit their all-time highs intradays at 194 euros per megawatt, which exceeds what we saw in last year's energy crisis. So beyond or sort of trying to exclude the impact or the potential threat of these cuts from Russia, the supply-demand balance remained tight, but it was recovering. We've seen improvement in gas storage levels in Europe thanks to an influx of LNG from the US and milder than average weather. So what this means is that in the midterm, or looking into the reinjection season of the year, which begins in April, the removal of Nord Stream 2 is definitely a blow to a potential recovery in gas storage levels, because it will force Europe to seek out more LNG cargoes, which remain relatively scarce, and will have to compete with Asia for those cargoes, which means that that wholesale prices look like they're going to stay high for a while, perhaps not at these current levels, but high in relation to historical levels.
So, Patricio, one of the things that you and I have been paying a lot of attention to is the European carbon market. It has been in the midst of a multi-year rally up until very recently here, and we've seen a tremendous negative move in carbon price since Russia's invasion of Ukraine. So carbon is down over 30% over the last few days. What is your take on what's going there? Because fundamentally, right, higher gas should mean you want to burn more coal, should mean higher demand for emissions credits. So how do you parse what's going on? And are we finally seeing a delinking between what's going on with the carbon market and the gas market?
Yeah, I think that's a question that only time will answer. But for the time being, we've seen this dislocation in that correlation between carbon pricing and gas. And one of the possible explanations for that is perhaps that this supply disruption threat has shortened or has narrowed European traders' options, because not only are traders not have this threat on them, but they're also avoiding to purchase gas or to commit to long-term contracts with Gazprom. So this has increased impact on gas price volatility in the near term. But if you look at the carbon allowance market, I don't see any changes in fundamental supply restraints. moving forward, but in the very, very short term, we may see a slowdown in industrial activity, which could be explaining this sort of maybe temporary dislocation that you mentioned.
I think it also raises the potential or the risk that lawmakers intervene and say, look, for now, we're not concerned about carbon. I do not think that Europe is going to walk away from its 2030 or 2050 climate goals, but right now we are obviously in the midst of a crisis, and so you might see some potential brakes or pause put on what's going there. Okay, so let's switch to another commodity which has also been roaring here over the last few days. We'll go to Salih Yilmaz first, our senior oil and gas analyst. Salih, tell us what's going on with oil macro, and what do you make of today's OPEC news, which just hit the wire a few minutes ago?
Sure. Thanks, Rob. So, last time we were talking about Brent a couple of weeks ago on this call, we were talking whether it would cross the $100 a barrel mark. And it did. And actually earlier today, it crossed the $110 a barrel mark. It actually touched 113. And both Brent and WTI were at some point intraday above 110. And I must say, our outlook at the moment is similar to gas, as Pat mentioned. Risk is very much skewed to the upside still. And this is obviously being driven by geopolitics, the Russian invasion of Ukraine. Risk of disruption for oil flows is extremely high at the moment. And we may not have gotten sanctions that are directly targeting energy companies, oil and gas companies, but the reality is that we are seeing a lot of market participants, such as banks, such as refiners, doing what a lot of people are calling self-sanctioning, which means even though technically these companies may not be sanctioned, they are shying away from doing business with them. So what we are hearing some traders say is that currently up to about 2 million barrels per day may already be out there struggling to find a buyer. So this is clearly impacting the market. And I should say, even before the invasion, you've probably heard us talk on this call multiple times, talking about how even before the invasion, the fundamentals for this oil market was already pretty strong. We already had very strong demand after the pandemic. We already had falling spare capacity. We already had very low inventories. They were all combining to kind of create this almost first year of multi-year deficit in the market. So this is only exacerbating what was already a very tight market. And on the second part of your question, we know OPEC meeting earlier today started about half an hour ago, and it was another record quick meeting. And they just kind of rubber stamped the 400,000 barrels per day that has been kind of the initial plan of an output hike of that amount every month. And I think their argument has been that technically there are no sanctions directly on these energy companies. So technically there are no disruptions yet. But again, as I mentioned, reality is different in the sense that there is all these barrels, Russian barrels out there that are struggling to find a buyer. So I think the market will probably take these OPEC news as bullish. And what we will see in the next few weeks is markets kind of slowly starting to price in a worst case scenario and kind of realize that actually a lot of supply is at risk of disruption.
Thank you, Salih. We'll come back to you in just a second. I want to bring on Will Hares, also a senior analyst covering the European oil majors. Salih mentioned the idea of self-sanctioning. So, Will, I want to get your thoughts on, we saw some really big announcements from BP, Shell, and others separating themselves from assets or entities that they have a stake in Russia. Do you see more evolution here, and how do you read the decisions that they've made?
Yeah, thanks, Rob. So
we've really seen Russia become essentially radioactive to Western energy majors just in the span of the last week. We saw BP's announcement on Sunday evening kicked it off with their sudden exit from their Rosneft stake, in which they hold 19.75% interest. We gauged BP as having the highest exposure to Russia as a result of this Rosneft interest. It wasn't clear specifically how they would go about exiting. We assume that they will pursue some sort of divestment, but obviously, given the spiraling geopolitical risks and the valuation for the market valuation for Rosneft just plummeting, we expect marginal proceeds to be realized from BP and pretty significant impairments as a result. Management signal that they could end up with 25 billion of non-cash write-downs. Beyond that, we also saw Shell and Equinor follow suit. Shell has moderate exposure, in our view, to the Russian market. Of course, they held 10% interest in the Nord Stream 2 pipeline, which has now been not just halted or suspended, but it looks like it's pretty much dead in the water. They also held a pretty material interest in the Sakhalin 2 LNG project over on the east coast of Russia. So this is just really consistent with how politically untenable holding these assets and interests is for these Western companies, and we've even seen some politicians in the West demanding meetings with management teams, and we suppose telling them that they have to get out of Russia. The last sort of holdout within the European oil majors is Total. They also have relatively high exposure to Russia through their 19% interest in Novatek, and combined with this, it gives them pretty material interest in two of Russia's largest LNG projects. That is Yamal, which is operating, and Arctic LNG 2, which is under construction. Total has said that they will restrict capital from new investments, which seems like a bit of a fence-sitting statement to us. And I am pretty suspect of this being, of this position being sustainable, as obviously the situation in Ukraine deteriorates, and we've seen some signals from French ministers pressuring Total as well. And I think just lastly, I would want to highlight Equinor, which is the Norwegian energy major. We have written pretty extensively and consistently in the recent months of how the company acts as a extremely effective hedge, not just to Russian military aggression, but also potential sanctions that may hit the global energy complex, and also inflationary pressures. And this really comes down to Equinor being the second largest gas supplier to Russia after Gazprom. They're ramping up their gas production to record levels. They have very high exposure to spot oil and gas benchmarks, and we've seen this manifest in a surge of their valuation in recent weeks.
Will, I want to get your reaction to the idea that Salih mentioned about maybe a couple million barrels per day coming off the market as a result of sanctions and the conflict, the crisis writ large. What kind of supply response do you think the European oil majors, the integrateds, the national oil companies can bring to the market? I suppose new investment takes time. So if you can't do Russia, where do you invest now, and what's the fastest resource to come to the market if we remain in a sort of tight situation for some time here?
So there is very limited levers here that European energy majors have to optimize near-term production. Very, very limited. We've seen effectively a mass exodus from U.S. shale from the European majors. BP is the only European major with material interests still in the Permian, and beyond that, these companies are all optimizing their productive capacity at the moment as they can. And so from a supply standpoint, there's very little these companies can do. Unfortunately, it's going to rest on the U.S. shale guys to pump up the investment in that short cycle capex to get those high IP but high decline wells online to try and offset some of this supply crunch coming from Russia.
Thank you, Will. We actually have a few questions from some of the folks who are listening today, so I'm going to take some of those and I'll dole them out. So one of the first questions that would be good to get some clarity on is IEA has released a coordinated release of stocks and want to get your assessment of potential market impacts. And we'll go first to you, Salih, to help frame what's going on there.
Sure. I think that's a pretty good question because SPR is something that we've been talking about, given we did have an announcement of it as a tranche back in November. And first of all, I should mention, I think SPR can be very effective and is a great tool, but should be used for the right reasons. I mean, the first time we heard about it being used back in November was essentially to manipulate prices, which was not the best use of strategic reserves. This time around, I mean, there is a disruption in one of the largest producers of oil. So this definitely feels like a lot more appropriate use of SPR. And what's been announced is a 60 million barrel release. And if we assume that this will be used in a matter of a month, 30 days, that would be about 2 million barrels per day of that could cover about 2 million barrels per day in this period. So again, I mean, the estimate that I gave earlier from what we hear from some of the traders, about 2 million barrels may be the amount that's actually being disrupted at the moment from Russia. So this would help cover that. But obviously, this is a number that is very uncertain. And I think the way things are going, I think it's more likely that we get a disruption that's higher than that. So I think it's definitely a good tool. Will it be enough? Probably not. But I should mention that the IEA, which is what's leading this release this time around, it will be a global effort. They are sitting on about 1.5 billion barrels of reserves. So obviously they can do more. And I guess when we have more clarity on what the market is missing and what the market needs, I think we may get further releases from the IEA.
Along these same lines, I want to go to Will, more macro here. But what's your sense on Iran? We haven't brought them into the equation yet. There's ongoing negotiations about potentially re-entering a nuclear agreement with the U.S. and other parties, and potentially getting Iranian production back onto the global oil market. Will, how do you read the tea leaves there? Is it even a relevant factor right now?
Yeah, sure, it's relevant, and it's probably the best answer to addressing, some of the crazy moves we've seen in oil in the last week. I mean, we saw a near 10 barrel a day increase, and our sense is that we are getting close to the finish line here on the Iran deal. Negotiations are ongoing day and night. I think it's quite clear that Iran is using the current geopolitical backdrop as leverage in its negotiations. They know how badly the market needs their sanctions to be lifted. We expect roughly 500,000 barrels a day of Iranian oil to be accessible relatively shortly, and possibly another 500,000 barrels a day, within 6 months' time. This obviously conditional on an agreement and export sanctions being lifted, and obviously these volumes are very, very meaningful to the current oil market at the moment.
Well, while you're thinking on the macro side of the equation, one of the things we haven't talked about is the SWIFT transactions. I believe energy has some special exemptions, some carve out there, but what's your read on that evolution there? And we've also just got a question in the chat asking about sort of the U.S. Being open to a wide variety of energy sanctions. So, are we going to see more on the sanction front, and how does the SWIFT component of the equation evolve?
Yeah, just quickly on the SWIFT. You're correct in that energy was carved out from SWIFT, but as Salih mentioned earlier on, the effect is kind of metastasizing already through self-sanctioning. We're seeing refineries, banks, ship owners, avoiding Russian crude and products, whether that's from just out of a regulatory cautionary standpoint, or maybe from a moral or ethical one as well. Regardless, we've got that near 2 million barrels a day of Russian crude and products struggling to find buyers. And then more broadly on the U.S. sanctions, this talk of direct energy sanctions on Russia has intensified in recent days, and I think this is in response to a step change in how the situation on the ground in Ukraine is evolving, particularly as it relates to military operations against or apparent military operations against civilian areas, and I think the West will be looking at any and all options, keeping them all on the table in order to exact the maximum economic pain and cost to Russia if it continues, this unprecedented military action, at least within our lifetimes.
Thank you, Will. Salih, I want to come back to you on another idea. Patricio and I put out a note making the argument pretty straightforward that higher natural gas prices help to underpin the sort of economic or business case for renewables in Europe. We've already seen Germany pull forward its date for ending fossil fuel power generation. Previously, they were targeting 2050. Now it's 2035. And my question for you, though, is, look, the same set of principles apply in the oil market. We've seen a tremendous rally in the price. Are we starting to see any kind of indication of demand response? Is there a potential for even a recession because of the higher prices? How does this sort of calculus feed into your view of the demand picture?
Sure, thanks, Rob. I mean, first of all, I did see your note, and I totally agree with it. I think what we're seeing with this crisis is that it will accelerate the transition into low carbon alternatives. And I think more and more parties will be committed to eventually becoming less reliant on fossil fuels from places like Russia. In terms of demand destruction, I mean, this is something that we've been talking about since when oil price hit $90 a barrel. And that was not long ago. So I think we need a little bit more time to kind of see what the current prices do to demand. But what we were seeing, even when we were between $90 and $100 a barrel, we didn't see too much of a hit to refining margins. We didn't see too much of a hit on refinery run levels. So we weren't getting too much of demand destruction at those levels. But again, I think we are very much getting closer and closer to those levels where demand starts getting destroyed. I mean, what's the number where we start getting a recession? That's very difficult for me to answer. But I think we are obviously on our way to higher prices. And I mean, if we do get to price levels such as $150 a barrel, which is apparently a level that a lot of traders were talking about a couple of weeks ago at IP Week here in London, I think those are levels where a recession is almost guaranteed. So again, I mean, we're watching very closely what happens with how much refiners, how many barrels refiners will continue to demand at rising prices. But it hasn't happened too much in the last couple of months when prices were already at levels that we thought would start destroying demand. But I think when we're talking 110 plus, this is certainly getting to those levels where we will see demand destruction.
Okay, thank you, Salih. Speaking of the idea of demand destruction and kind of what's going on that could be different in the energy landscape, we have a question from one of our listeners who is asking about, does the gas crisis put coal back on the table? And I would just note that if you look at 4Q of last year, coal generation in Europe was up about 16% already before where we are today. If you look at the January and February numbers, you're seeing coal gen up 20% or thereabouts. So it's quite clear that we are seeing some near-term bump in coal generation, but I want to get your thoughts on that evolution there, Patricio. How do you read coal in the European utility landscape over the next couple of years?
So I agree in broad terms to what your view on this is as well. For European utilities, we don't see any long-term impact on their energy transition plans. Most utilities will remain focused with 50% or more of their capex focused on expanding their renewable capacity in wind and solar across the globe, really. If we see this sort of immense price volatility in gas, of course there will be an incentive to reignite their coal plants, but this could be a fairly small blip when looking at the long-term trend towards renewables. We could see a resurgence, but that could also be capped if carbon prices once again pick up. So if anything, I'd see this as a near-term blip rather than a structural change.
Okay, thank you, Patricio. Will, one last thought from you. Okay, so if coal's not coming back into the mix, gas is a bit of a tenuous situation. A number of your companies that you cover for BI have made some pretty big objectives to invest more heavily in renewables, particularly offshore wind, also solar. Do plans for any of that change as a result of the current market situation we're in?
So, in the sense that there's some limited and marginal levers to pull here from the operational side. So, for instance, Equinor is optimizing some of its flexible gas fields in Norway. So yes, there are some minor operational responses to maximize exposure to these oil and gas prices, but more broadly, no, there's no change to energy transition strategies. We are seeing these strategies accelerate. Last year, we estimate roughly 15% of capex programs was allocated towards green or energy transition businesses or M&A. We expect this to be around 20% this year. And we think that that by the end of the decade, most of the companies have come out and said guidance for 50% of capex will be greener transition by the end of the decade. We personally think that this could be significantly higher. So the transition is a runaway train at this point for the European energy majors. It is happening. and multi-year highs in oil and gas pricing, or record highs for gas pricing, I should say, will be seen as a cash generation catalyst to fund the energy transition, not to withhold it or slow it down.
Will, very provocative end to the conversation. I think we're going to leave it there, but we've got a lot of very interesting ideas for our clients to think about. We've got record commodity pricing, which in some sense may help drive cash flow that speeds up the energy transition. Regardless of whether you agree or disagree, you can find all of our research by visiting BIGO, and we are certainly happy to entertain individual discussions. Shoot us an IB if you've got questions, and make sure to look for us on the first and third Wednesday of every month when we get together and have these discussions. I hope everyone has a great remainder of their week. Thank you for your time.